Australian residential property is now worth $12.6 trillion. Not billion. Trillion. And despite 2 interest rate hikes already this year, despite mortgage stress hitting record levels, despite every prediction that this was a year it would all fall apart, national home values still rose 9.9% in the year to February 2026. So why does it feel like the crash is coming? And more importantly, are those feelings right? Here's what nobody tells you about property crashes in Australia. We've had 10 capital city downturns in the last 40 years. 10. And all but 3 of them lasted less than 12 months. What you're being told is a crash might actually be something completely different, and the distinction could cost you, or make you, hundreds of thousands of dollars. By the end of this video, you'll have the actual May 2026 data from Cotality, that's formerly CoreLogic, PropTrack, SQM Research, and the ABS. You'll know what's really happening in each city, why this market keeps defying the doomsayers, and what the current data says you should actually be doing right now. Let's start with what the data actually shows, because the headline figures are being seriously misread by most people. In April 2026, the Cotality Home Value Index recorded national home values rising just 0.3%. That's the weakest monthly growth in nearly a year. And PropTrack recorded the first monthly decline of 2026 in April, down 0.1% nationally. The national median home value now sits at approximately $910,000 according to PropTrack. And for the first time ever, the combined capital city median crossed $1 million, sitting at $1,014,000 per Cotality's February data. Sydney and Melbourne are already in early stage decline. Cotality's research director Tim Lawless noted in May 2026 that both cities are 5 months into the early phases of a downturn. In April, Sydney and Melbourne each fell 0.6% in a single month. On an annual basis, national growth has decelerated from 10.2% in January down to 9.9% in February, and the trajectory is pointing lower. That sounds alarming on paper. But here's the thing. The data is telling 2 completely different stories at the same time, depending on where you look. While Sydney and Melbourne dip, Perth is up 2.5% in a single month. Brisbane is up 1.8%. Adelaide is up 1.2%. Ipswich, a major population centre within driving distance of Brisbane, recorded annual growth of 19.7%. Logan came in at 19%. Toowoomba at 18.2%. These aren't micro-suburbs or speculative anomalies. These are real, growing cities with real infrastructure and real employment bases delivering near 20% annual growth, while Sydney is sliding backwards. I'll come back to what that divergence means for you. But first, let's talk about the crash prediction that has been wrong for 20 years. Most people assume that when interest rates rise sharply, property prices must fall sharply. It sounds logical. Higher rates mean higher repayments, which means fewer buyers, which means lower prices. Clean cause and effect. Here's what nobody tells you, that logic ignores the supply side of the equation entirely. And in Australia in 2026, the supply side is arguably the most important part of the story. The federal government's housing accord set a target of 1.2 million new homes over 5 years. The National Housing Supply and Affordability Council is currently forecasting actual delivery of approximately 938,000 dwellings. That's a shortfall of 262,000 homes, and the council expects the shortage to worsen by a further 79,000 over the 5 years to 2028 to 2029. Let that sit for a second. We are building roughly 44,000 fewer homes per year than we need to, every single year. At the same time, Australia's population grew by 423,600 people in the year to September 2025, reaching 27.7 million. That 1.6% annual growth rate is being driven by net overseas migration of 311,000 people per year. As of January 2026, there were 2.98 million temporary visa holders in Australia, the highest number on record. New arrivals typically rent first before they buy. They are landing into a rental market where the national vacancy rate is sitting at just 1.2% according to SQM Research's April 2026 data. A healthy rental market has a vacancy rate around 3%. We are at less than half of that. So you have record numbers of people arriving, more people needing homes than ever before, a construction industry that cannot build fast enough, vacancy rates near historic lows, and a government housing target that is already running 262,000 homes short. This is not a market on the verge of a supply-driven crash. This is a market where prices are being held up by a structural shortage that cannot be fixed in months or even years. The mortgage stress story is real. I'm not dismissing it. Australia's national mortgage serviceability ratio is at 45.9% of gross household income. In Sydney, it's 54.7%. Renters are spending 33.4% of their pre-tax income on rent, above the housing stress threshold of 30%. Rents nationally have risen 42.9% over 5 years, according to Cotality's data. These numbers describe genuine pain. Genuine stress for real families. The kind where you lie awake at 2 a.m. doing the same calculation again, hoping it comes out differently this time. But here's the mechanism the crash narrative keeps getting wrong. High mortgage stress doesn't automatically translate to forced selling. It translates to people making sacrifices, cutting spending, taking second jobs, renting out a spare room, before they let go of the asset. Australians, culturally and financially, hold on to property for as long as humanly possible. And with outstanding mortgages totaling only $2.6 trillion against a total residential property market worth $12.6 trillion, that's a loan-to-value ratio of just 20% nationally. The system has enormous equity buffer before any forced selling cascade becomes structurally possible. So what is actually causing prices to slow, and why does it vary so dramatically by city? There are 3 real mechanisms at work in 2026 that nobody is explaining clearly. The first is the borrowing capacity squeeze. The RBA raised the cash rate to 3.85% in February 2026. It has since raised again. Financial markets are currently pricing in potentially 3 more hikes before year-end. That compresses what any given buyer can borrow. The Westpac Melbourne Institute time to buy a dwelling sentiment index fell to 82.9 in March, a new cycle low, and way below the long-run average of 120. Buyer confidence is cracking. The second mechanism is city-specific supply dynamics. Perth currently has advertised stocks sitting at 40% below its 5-year average. Brisbane is 29% below. In Perth, the median days on market for property is 9 days. 9. Properties are listed and gone in a single week. That kind of scarcity has nothing to do with interest rates. It's pure structural imbalance. Meanwhile, Melbourne has been absorbing new supply more efficiently and has more investor stock potentially returning to market. Sydney faces a dual pressure of extreme unaffordability at the top of the price stack, combined with serviceability constraints hitting mid-tier buyers. The third mechanism is price point stratification. Even within Sydney right now, the divergence is striking. Cotality's May data shows that lower quartile Sydney house values rose 0.8% in the most recent month, while upper quartile values fell 0.9%. The expensive end of the market is softening. The entry-level and affordable segments are still competing hard. First home buyers, investors, and upgraders are all competing for the same cheaper stock. That competition holds a floor under prices even as the premium market corrects. And the rental market is doing something that supports prices in a counterintuitive way. As of April 2026, the national average rent across capital cities is $794 per week according to SQM Research data. That's up 7.3% year-on-year. For investors calculating gross yield, the denominator, the rent, is rising even as a numerator, the asset price, stabilizes. Gross yields are quietly improving. That makes property more attractive to investors at the margin, which is a support mechanism for prices that barely gets talked about. KPMG's 2026 forecast is for national house prices to rise 7.7% over the year. CBA, Westpac, and ANZ are all forecasting growth of 4.8 to 5%. Not one major bank or research house is forecasting crash. What they are forecasting is a 2-speed market with a soft landing in Sydney and Melbourne and continued solid growth in Perth, Brisbane, and Adelaide. So what should you actually do with all of this? Let's make it practical. First, If you are in Sydney or Melbourne and you're a first home buyer watching this thinking the crash is coming and you should wait, the data does not support that strategy. What you're more likely to see is a period of flat to slightly declining prices in specific segments, followed by renewed upward pressure when rates eventually turn. Every time rates have fallen in the last 20 years, Australian property responded with a run-up. Waiting for the crash that doesn't come is one of the most expensive decisions in Australian property history. Second, use a current sentiment dip as your window. When the Westpac Sentiment Index is at 82.9 and buyers are nervous, competition thins. Auction clearance rates have been easing through the first quarter of 2026. You have more negotiating power right now than you did 18 months ago. That matters. Third, look at where the structural data is pointing. Perth, Brisbane, and Adelaide are not slowing because the fundamentals are weak. They are slowing slightly from extraordinary growth rates. Perth at 40% below average advertised stock doesn't suddenly normalize because the RBA hikes. The supply shortage is years in the making and years from being solved. If you're an investor and you're looking at entry points, the Brisbane Outer Ring is producing double-digit annual growth at sub-$700,000 entry points. Unit markets in Brisbane's Middle Ring are delivering 4 to 5% gross yield alongside capital growth. These numbers don't last forever, but right now they are real and they are documented in the May 2026 data. Fourth, if you already own property, understand your equity position clearly. The total value of residential real estate at $12.6 trillion against $2.54 trillion in outstanding loans gives the average Australian homeowner an enormous equity buffer. If you're sitting on a $900,000 property with a $400,000 mortgage, a 10% price correction gives you a $490,000 loan-to-value ratio, still completely manageable. Your risk is not what the media is making it feel like. Use tools like Moneysmart's mortgage calculator to stress test your repayments at different rate scenarios. If you're looking at buying, a mortgage broker can help you understand your actual borrowing capacity under current APRA serviceability buffers, because that number has changed significantly in the last 12 months. Here's what the cost of sitting still actually looks like. The combined capital cities home value index has risen 33.7% over the past 5 years. Markets like Perth, Brisbane, and Adelaide are up 80 to 90% over the same period. If you had a buyer who delayed purchasing in Perth in 2021 because the crash is coming, they are looking at a market that has nearly doubled without them. That is not theoretical. That is a documented outcome for people who waited. Nationally, rents are up 42.9% over 5 years. If you are renting right now in a capital city at the median of $794 per week, you are paying approximately $41,288 per year, a number that didn't exist at that level 5 years ago. Every year you wait to buy, assuming even modest 5% annual growth, the deposit hurdle rises by $45,500 on the median capital city property. You run faster. The finish line moves further away. Property crashes in Australia don't look like crashes in the US or Ireland. They look like short, sharp corrections of 10 to 15%, mostly in specific cities and specific price bands, followed by recoveries driven by the structural supply shortage that nobody has solved. That's the pattern from 40 years of data. And nothing in the 2026 numbers suggests this cycle will be different. The crash might still come. I'm not a crystal ball. But the people who have been predicting it since 2010 haven't been right yet. And the data that would need to change to make them right isn't moving in that direction. Before we go, if you haven't subscribed yet, hit subscribe now so you never miss when we break down something the average Australian isn't being told about their money. And drop your answer in the comments. Do you think Australian property prices will be higher or lower in 5 years from now? And what's driving your view? I read everyone.